Hello, chart watchers, and welcome to this Tuesday, November 27th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Take a look at the market action, trying to extend yesterday's gains. Currently, the Dow is struggling just a bit, down 24 points, but the S&P 500 has made it into positive territory, up 2 points. The NASDAQ tacking on 10.5. Russell 2000 still lagging a bit, down about 4 points. The 10-year Treasury yield, relatively flat, down maybe 1 basis point to about 3.07%. Volatility index down slightly. We did get a gap up at the open with the market weakness, but the market has recovered. And as a result, we see the VIX coming back down again, currently at 18.83. Again, the 16-17 area is a level we really want to watch closely if the VIX continues to drop. Among some of the stronger areas of the market, utilities leading today thus far, up about 0.5%. The XLC communication services up a little bit more than 1/3 of 1%. The dollar having a strong day today, trying to break back out above the high that we saw earlier in November. And as a result, you might imagine material struggling. That is the worst performing sector today. Gold also taking a pretty big hit thus far. Last time I looked, I think gold was down about $10 an ounce, and you can see that reflected here in the GLD. United Technologies announced they would be splitting their company up into 3 separate individual independent companies. Market not really liking the news, down almost 6% on the news. UTX very close to that late October low. Erin, Tuesday, second day of the week.
Yes.
Trying to get over all that turkey I ate last week.
Yeah, I'm still working on those leftovers. Probably not a good idea, because turkey that's that old probably shouldn't be eaten anymore.
Now you tell me.
Yes, I don't need you to get sick. I need you here.
I'll be here. Don't worry. Can't get rid of me that easy.
Yeah.
It was a good weekend. Lots of family, lots of football. Now we're back at it. Market trying to kind of right
something, right?
Yeah, I'm not going to say that it's bullish, but at least it's not overly bearish. So I guess that's positive, right?
Right. I would say so. Is December, though? I know that's, seasonality wise. Should we be expecting, you're the seasonality guy after all. What are you thinking about this December?
Historically, it's a bullish month, very bullish, especially for small caps. It's the best month of the year for both small caps and for the S&P 500. And January is the best month for the NASDAQ. But all three do enjoy the month of December. And especially once we get to about the 20th of December, that's when the seasonality really picks up. Very, very bullish around the holidays and through New Year's. We'll see whether or not that continues. But currently, up until about December 5th or 6th or so, we're also in a pretty strong period. And then historically, there's this little lull from about the 6th or 7th of December through about the 15th. And then second half of December tends to be very, very strong for equity. So we'll have to see what the technicals look like at that time. But at least
maybe the headwinds aren't going to be as strong this December. That we'll have to see. I'm still looking for more downside, but maybe it won't be quite so painful.
Well, the historical stuff, and I always talk about this, I mean, it is no guarantee for sure. And even if it's got a strong historical tendency, it doesn't mean that it doesn't ever go down. You can still have down periods during historically bullish periods, but the tendency is for the market to do well. So for instance, I think if the market started to regain its strength and we started to see some positive technical signs, that would really help to have the historical tendencies on the sides or on the bulls.
Excellent. Well, thank you for that.
We shall see whether it pans out. But what do we got going today?
All right. Upcoming schedule. Mark Chaikin's going to be with us tomorrow. Can't wait. I know he's going to be talking about the FANG stocks, so you'll want to tune in for that tomorrow. We have the seasonality report. We just gave you a little bit of a preview. Tom's going to give that to you on Thursday. And then Friday, Mary Ellen will be back with what's hot and what's not. And just a little preview, she's going to be co-hosting on Fridays because the Decision Point Report show will begin on Fridays at 2 p.m. Pacific, 5 p.m. Eastern. I'll give you that wrap up I normally do on Monday, but you'll get it on Friday. So that should be good. All right, today's agenda, however, gap trading strategies. That's the workshop Tom's getting ready to present. It's always a good one. We have our 10 to 10 to 1, 10 and 10 to 1. First stock is going to be Altria Group, MO, and then we'll finish up with technical scans. I'm going to show you how to do a scan with the Elder Impulse system. So stay tuned for that. All right, Tom, technical news headlines. A little more interesting than yesterday.
Yeah, we actually have some economic reports, which was kind of nice. Bond market really hasn't reacted too strongly to any of it, and mostly because I think it's fairly close, as you can see, to what was expected. But September Case-Shiller Home Price Index rose 0.3%. That was as expected. September FHFA House Price Index rose 0.2%, which came in just a tad short of the 0.3 expected. And then November Consumer Confidence was out at 10 a.m. Eastern, and that fell just slightly short as well, 135.7 versus 136.5. And if we take a look at the reaction in the bond market, it's pretty much just a yawn. I think at this point we had the big move down in the yield. I think we're down here testing area of support around 3%, 301, just a little bit above that level. But I do think we might continue to meander down around that area. But I'd be careful, I guess, if we move below that 3%. That would be another warning sign to me, as money would be rotating more toward defense there. But sideways consolidation after an uptrend is really not that big a deal. So I would just continue to watch this range. We also have, there's going to be more attention turned to the Fed as we head into December. There's a lot of talk now. Should the Fed be raising any more at this point, given what's going on with the stock market? I mean, the stock market's one of the best leading economic indicators, and if it's indicating something right now, it's not very good based on what we've been seeing with the major indices here in the U.S. So, is that going to change, what the Fed's thinking? The Fed has started to hint that they're going to be much more data dependent going forward. And one of the Fed officials that was out this morning and said that we're much closer to neutral than we were before. So I don't know if now they're starting to kind of play this game where they're, not forecasting, but almost like giving away the, what they're planning to do. They try to be very transparent. And so I don't know if maybe that's what's going on now, and maybe it'll come into question. But I do think most traders are expecting another quarter point rate hike in the Fed funds rate. So we'll see as we get into December what the bond market is telling us. Right now, the bond market, as I said, yield's been pulling back. Money's been rotating into treasuries. It's not exactly what you would be looking for if you thought there was a rate hike coming. But we'll see. Still a lot of time to go before that next announcement. Okay, let's take a look at a couple of earnings reports, because there were a few. Not anything huge, but we've got Bank of Nova Scotia coming out, posting earnings as expected for the quarter. Eaton Vance, same thing. Cracker Barrel, this was one we talked about yesterday, and I mentioned, and one of the reasons why I put it on here is that given the huge run-up in price of late, kind of speculated that they might have a good report. They beat on the top and bottom lines. They raised their comp store guidance going forward, and the stock, after gapping lower, which we also talked about, has exploded to the upside. Buckle, on the other hand, was one that had been underperforming in terms of relative strength versus its peers, versus the S&P, and they came out, they missed on their top line, and you can see just matched 42 cents on their bottom line. So we'll take a look at those charts in just a minute. After the bell tonight, we've got Salesforce.com. That's going to be the big one. And then another one that's maybe about a $5 billion company, Nutanix, NTNX, will also be reporting. All right, so let's take a look at what's going on here. I'm going to start off first with the S&P 500. And the reason I'm going to start here is we did break back up above that 20-hour moving average, and so far we're holding it, but this hasn't been a real impressive rally. I mean, I'd really like to see us push through 2680 to 2690. Here was the gap resistance up here at about 2690, and we took out the double bottom, the support area that we had around 2680. You can see that also lined up with this gap support. So that had been holding, and then we gapped beneath it. Now we're trying to get back up through 2680. I would even stretch it up to 2690 because of that gap resistance area there. But I think the 50-hour moving average is pretty important here, because on this move up, this comes on the heels of a positive divergence printing. So we've got lower prices, we've got higher PPO, and that normally leads to a 50-period test, which is what we're getting right now. So it is very possible that we're just doing what slowing momentum to the downside would suggest that we do, which is go to the 50-day moving average and then maybe turn back around. So I think this afternoon is going to be somewhat important because so far this move through the 20-day, even though we are holding, looks a lot like what we saw just 10 days ago when we got above the 20, but we never really separated from it. And then all of a sudden the selling kicked back in again. We got to be really careful here. But I think a break above 26.90, I think would begin to suggest that this is more than just a short-term bounce and could turn into maybe a little bit more of an intermediate-term bounce. I don't think we're out of the woods, by the way, in terms of whether or not this is a correction versus a bear market. I don't think we're out of the woods until we take out this double top up here. I think we've got to get through about 28.20, and obviously at 26.74 right now, there's a long way to go. So I think if we get through the short-term resistance, then we could perhaps maybe move into something that's a little bit more intermediate term in terms of an advance, but we'll see. All right, let's take a look at a couple of these stocks that I mentioned. Let's start with BNS, Bank of Nova Scotia. And I'm going to pull up this relative chart because this is what we had talked about yesterday at one point. You could see Bank of Nova Scotia topped all the way back in January, has been underperforming, really weak. We talked about the fact that it had broken to a new low, even though the bank index had not. And so what this means, you've got one of the weaker stocks in the banking area. You can see right here, very close to a relative low. And you can see the banks overall have been pretty weak versus the S&P since back in February. So I was not expecting much out of this report, and we really didn't get much out of this report. They met their bottom line. They missed on their top line. And you can see that the reaction so far, only down 0.5%, but not breaking this downtrend. Another stock, Eaton Vance, we didn't mention this. We didn't talk about this one yesterday, but I think it is pretty interesting, though, that the stock has been in a downtrend. The group asset managers been in a downtrend, but look at the relative weakness of Eaton Vance coming into this report. They did meet expectations on the bottom line, rallied initially back up to the 20-day, but you can see that failed. Not a really good looking chart here. The one I really wanted to mention, though, was Cracker Barrel, because with the huge move up here, this was the one yesterday I said, okay, can't imagine a bad report here. There's a lot of money rotating into this. It's already in a nice sector, or excuse me, nice industry group, restaurants and bars, which have been very strong. And you can see over the last 2 months that this has been one of the better stocks within the restaurants and bars. So the group, or this stock, is getting a lot of money rotating toward it. But I speculated that maybe they'd come out with a good report, but it would be a buy on rumor, sell on news kind of an event. Look at what happened at the open today. The stock sold off about $4 at the open, but has come roaring back and has broken out again. CBRL looks really good here. Last one is BKE. This is Buckle. Another one I speculated would not be a very good report. You can see that back in August it topped, even though its apparel retail group didn't top until November. And what that had resulted in was a very, very weak relative chart versus its peers. It did start to rally a little bit, but the overall downtrend, I think, was in play. Buckle missed on their top line, matched their bottom line, gap down so far, holding on to support, but really not a very good reaction. Stock down almost 8% today. So, Erin, I know you've got a number of upgrades, downgrades. What you got for us today?
All right. Well, interestingly, yesterday it was all about the upgrades, and today it's all about the downgrades as far as the list. I thought what we were seeing today. Let's go ahead, and we're going to start with some of the upgrades. Disney today was upgraded by Imperial Capital from an inline to an outperform. It's been moving sideways in this trading channel, and it's at the bottom of that channel. And I would say that it's getting the upgrade. I would look for it to go back up to the top of that channel. I don't know that we're going to really see that much in the long-term trend to the upside, but sitting at the bottom of a trading channel, it makes sense to maybe go ahead and get on board with that. You can see the PMO is still in positive territory, but it is decelerating. So I think this one is decent for the watch list. Disney. My Tech Systems, MITK, was downgraded today from a hold to a buy. I know this one's rather low volume, but I really liked the look of this chart. as far as the breakout goes up here, and I'm going to make it a weekly chart for us here. You can see that we're just now to that $10 mark. And if we can get that breakout, we've got a nice move up to, that 1075 area where we had that top back in 2017. You've got, in terms of an intermediate term trade, you do have the buy signal, and the PMO is just about ready to get above that previous top. So I think that would be a positive situation as well. All right, daily chart, not quite as enticing as far as a short-term trade, just because of that PMO sell signal in overbought territory. World Wrestling Entertainment was upgraded today by FBN Securities from a sector perform to an outperform. It's not been having the greatest time here this fall so far. It's been falling. And you can see that the declining tops trend line, I don't have it drawn in here, but if I did, you could see we're still below that. The good news is we've got a PMO that is oversold and is rising, could end up with a buy signal here. And that point, I might relook at this, but currently we're having trouble getting back above that 200-day EMA. And I wouldn't want to get into anything like that. Look for the breakout from the declining tops trend line. Look at the PMO and make sure we're getting some decent support from that 200-day EMA. But I think this one again might be interesting for a watch list. Some other big name upgrades that I'm not going to be going over. A.O. Smith was upgraded. Sotheby's BIIB was upgraded today as well. So I'm not looking at those today, but let's go ahead and we're going to look at the downgrades. First one, Comerica CMA, downgraded by Macquarie from a neutral to an underperform. You can see the PMO has gone into a whipsaw buy signal right now. It looks like we're forming a double bottom off of a long decline. So this one looks very interesting to me. We do have rising bottoms on the PMO and then declining price bottoms, and that's a positive divergence. So of them, I think it's interesting that they are downgraded today because honestly, I think their chart is probably one of the better ones that we're going to look at today. So anyway, looking for that double bottom, looking for a move up to that $86 level. Got to watch the PMO, make sure that the momentum continues. You can see OBV right here in the thumbnail, that declining tops is being broken. So the volume looks like is coming in okay right now too. Hormel Foods downgraded today by Jefferies from a buy to a hold. I'm with them on the downgrade. I've got a PMO that's giving me a sell signal right now on a rounded price top. I wouldn't expect prices to move higher at this point. I do notice though, and I don't follow the candlesticks, but I suspect we could end up with a hammer candlestick today, just based on that trading, and hammers are bullish patterns. So, we could get a bounce off of it, but I just don't care for it because of the PMO. So I'm out of that. PNC was downgraded today by Macquarie from an outperform to a neutral. Could be forming a flag here. I found it interesting because not only PNC Bank was downgraded, or financial services, we also saw Credit Suisse, CS, downgraded for a second time. It was downgraded yesterday as well. And US Bank also being downgraded. So we have three very large financials, and they're being downgraded. And I would have to say the PNC chart looks pretty good just because of this flag. But if you were to pull up, for example, USB very quickly here, oops, yeah. If you do that, you can see that we had, it's looking a little bit better than that PNC chart as far as the tops. We've got the higher tops going on here. So, all right, let's see, where did everything go? There we go. Okay, so let's look at one more. Wyndham Destinations also downgraded today by Goldman from a buy to a neutral. We could be looking at a flag here, but as I like to say, sometimes if they get too long in the tooth, the flag starts to just really get very long in comparison to the flagpole. I kind of lose interest as far as that chart pattern goes. But right now, we have an interesting setup here. Possible flag. 20 is crossed above the 50. The only issue right now I have is the PMO is trying to turn over. but it isn't in overbought territory. It could turn itself back around. So I think this one could be worth a watch on the watch list. So that's all I had for the upgrades, downgrades. Here's your summary, and I will put this in the Market Watchers live recap today if you want to go back and look at these. All right, Tom, time to get you started on that workshop, Trading Gaps.
Yeah, I want to go ahead and just start out. I'm going to show just the thing is there are gaps in the market all the time. And so the gaps that I want to really focus on in this particular workshop are the gaps related to news of some sort, mostly earnings gaps, but the ones that come with volume. So let me go ahead and show you first of all, if you're not familiar with gaps, what I'm talking about. So here, for instance, on Costco, and this is just going to be used as an example, just to show you any old gap. Yesterday, now on these red filled candles, the gap or the open on a red filled candle is at the top of the rectangular body. So it opened yesterday, and one way you can double check it is click this inspect button and come over here. You can see that Costco yesterday opened at 222.85. The day before, it had closed at 220.06. So it had opened up $2.80 roughly. Now, you might say, well, why? You know, what happened to Costco? Well, nothing happened to Costco. But if you remember, yesterday morning, the futures were way up. So the overall market was moving higher. And therefore, many stocks simply gapped up because the overall market was strong. No news, at least I'm not aware of any news that came out on Costco yesterday, other than the ordinary. But we just had this gap up. And what most gaps are just that, common gaps, where they're not really news related. They're just, could be the overall market. It could be something in the sector, one sector, maybe the defensive stocks have an edge. And so if a company is part of that defensive sector, they'll get a little bit of a gap and a move higher at the open. Most of these common gaps will do what we call fill the gap. And that simply means that after you go gap up from the prior close, you go back down and you test that prior close. Now, with no news, usually there's light volume. And if you look at the intraday chart yesterday from Costco, just pull up a 10-minute, 5-day chart. You can see this is where it closed after the shortened holiday session from Friday. So here was your close at 219 and change. Here was your open up at 222. And after that open, and you can see volume just kind of so-so for Costco, nothing huge. But after that gap up, we simply went back down, filled the gap. And then Costco went down a little further. Now it's rallying back. But that back and forth is very normal in the stock market on a regular daily basis. You have a lot of individual stocks that will make that move up or down at the open and then kind of come back at some point, fill the gap, maybe that day or the next day or within a couple of days. But usually those gaps are filled. I'm going to focus more on gaps resulting from major news. And most of my trading revolves around earnings gaps. So that'll be the majority of what we talk about today. But let me go ahead and I'm going to go through, and what we're going to do today is just look at a lot of charts. When I studied gaps, this is really what I did is I just looked at hundreds and hundreds and hundreds of charts, literally thousands of charts over the years, and just started to get my eye trained on a lot of reversals that take place at key areas after gaps take place. So what we're going to do is take a look at a number of individual stocks and then just hopefully this will shed some light and give you some things maybe to look at if you don't already trade gaps, some things that maybe might perk your interest as far as short-term trading, if you do like to short-term trade. So let's start off with the first one here. This is Five9 Inc., FIVN. Now you can see back in August, look at the volume here. The stock had closed around $35. The next day it opens almost at 40. I can tell you that was an earnings-related gap. So the company came out, beat top line, beat bottom line, Wall Street estimates, and you can see the market's reaction was very powerfully bullish to the upside. Now, after it gapped up, one of the things I really like to focus on is what kind of candle prints. And in this case, you can see a really nice hollow candle. And for those of you who don't follow candlesticks, what this hollow candle is telling us is that 5/9 gapped up to almost $40, but didn't close that day until it had gotten up to almost 44. So when you think about a gap up, and if you understand how the market works, when everybody wants to buy, like they did here at this open after the really solid earnings report, market makers are on the other side of the trade. They're the ones that provide liquidity. So the big thing that when you're looking at gaps, the thing that stands out to me is you're really starting to get an indication of what market makers are doing with a stock. At least for me, that's the way I interpret it. So in this case, you can see FIVN gaps up, very heavy volume, but notice we hardly come down at all that particular day before we took back off and went even higher. So what that tells me is that market makers, which typically are going to be on the other side of the trade because they provide liquidity both on the long and short side in the very near term in the market, they're going to be on the short side selling into everyone else buying because they're going to be on the other side of those trades. But when you get a hollow candle like this on very heavy volume, it's telling you that market makers really were not able to gain control of the action, because normally after a gap up, we talk about a gap fill, which I just discussed. Well, that would require a lot of selling to take place to get the stock all the way back down to 35. In this case, it continued pushing higher. There was too much volume. Market makers have a lot of capital, but they have limited capital, and they're not going to get in front of a freight train. When everybody wants to buy a stock, they're going to eventually give in, and that's why you're going to see these really bullish candles. And if you notice, over the course of the next 2 or 3 weeks, FIVN 5/9 continued moving higher until it finally topped in about the $48, $49 area and then started rolling over. Now, at this point, once you reach a top and you can see that false breakout, that last ditch effort to move higher there, lesser volume, long tail to the top. At this point, it's easier for market makers to gain control on the short side. And so it's not too surprising to see a stock at least pull back to a moving average. In this case, we went right through it, and we kept working our way. Now, it took about 2.5 months, but FIVN went all the way back down to gap support. It did fill the gap, but it took a while. And so when I'm looking at a chart and I put a stock like this on my list to buy, I'll usually annotate my charts showing gap support at the top, a lot of times gap support at the bottom. I could maybe sometimes even annotate a price support level. Like, let's say this high had been up here at about 42. Then this candle would have broken above that prior high and would have established price support at 42 going forward. So that might have been another line that I may have drawn on a chart. But I usually just put these support resistance lines on a chart just to kind of quickly allow me to zero in on some of the levels where I'd be looking for maybe a reversal. Now, if you look at FIVN, we didn't reverse at the top. That was a little surprising. And I don't think this one I had. But if I had bought this, I might have bought right about the time it came down and tested the top of gap support. And I'll be showing you a number of charts where you'll see exactly what I'm talking about, where that provides great support. But in this case, we went down, bounced one time, stayed under that 20-day, and we went all the way down. And even on an intraday basis, we went below gap support. That move below gap support intraday and then coming back up and holding it, that to me is pretty significant, because when you're breaking down like this below gap support, if I was looking to get into a stock, I'm not going to get into a stock that's looking like it's breaking down below that gap support level. I don't know that this is going to turn around intraday. When I see gap support being lost, I start looking at the next support level, which would have been all the way down here at about 32. But the fact that it came down below that support level, gap support level, and reversed suggested that we might be in a pretty good position there for a quick reversal to the upside. And the beauty of it is you can keep your stop really tight because you're down near support. Problem is, when you get in, a lot of folks just get in whenever. If you get in up here and you're looking for a support level to put in a stop, I mean, I would be looking maybe at the 20-day. Beyond the 20-day, maybe a little bit of price support at 44. Then I'm looking down here at 39.5, and then I've got gaps. I mean, This is what gets you into trouble, is buying a stock and then holding it and letting the losses mount before you finally say, hey, I need to get out of this. If you start making emotional decisions, you're going to lose money, no doubt about it. So you want to try to be as business-like as you can. Notice also on this reversal, I had connected the trend line here. If you can find multiple reasons why a stock looks good at a certain level, the more reasons, the merrier. I want to know that there might be folks buying because they see the trend line support. I know some people might be buying because they see this gap support. Some people might be buying because off of a downtrend, they see a hammer. There's a lot of different reasons why folks might be buying this stock. The more, the merrier, no doubt about it. So anyway, I just wanted to point out, you can see the gap support held here. Next time we came down here, same thing. We hit the same level and bounced off of it. So it can provide clues, not just for one trade, sometimes multiple trades. Now, I went through a lot of explanation there, but I'm going to go through a lot of these other charts much quicker so that you can get a feel for a lot more charts. But here is AeroVironment, small company, gap up. Again, look at the volume coming in on this gap up and the huge move to the upside, continuing high volume. That tells me there's a lot of accumulation taking place. But once again, look what happens afterwards. If you're patient, many times these stocks will come back to you. Came all the way back down. In this case, went just slightly below gap support and then reversed. Now, I might look at this, and if I had bought, I might have gotten stopped out on that. But if I hadn't bought at that point, on this next day, it's kind of like a piercing candle off of a downtrend, and it came back up and held this support level. And if you think about it, if you combined these 2 days' actions, and if you could imagine what that candlestick would look like, you would have opened up at that 90 level. You would have come down to the low here the next day of around 84, and then the close that day is up around 88. These two candles combined would have been like a hammer. Now, you might have problems visualizing that, but if a hammer had printed here, I'd have been all over it. Well, if you see two candles that kind of do the same thing, you have the breakdown and then the reversal coming back up to hold support, that can get you in with a fairly tight stop, just a few dollars to the downside, and then a rally. I think AVAV was actually a setup that I went over maybe a few weeks ago off of that move, off of that support area on that reversal. So, I think it was right at the end of October. But anyway, this is another one where if you watch this gap support level, it's so far been holding over here again a second time. HD Supply Holdings. Now, a couple things here. Notice here's a gap up. Now, I'm going all the way back to June, but big volume, gap up. I do believe that was earnings related right here. And notice that top of gap support, we never went back and filled for the next couple months. But every time we came down and hit this top of gap support, we bounced off of it, creating some short-term trading opportunities with a fairly tight stop. Now, with the earnings that came out in September, the stock sells off, and you can see the volume pretty strong. But the thing that really, we did bounce the first time off this support level, but I remember it coming back down and looking at the chart and not getting involved because I didn't like the bearish the bearish tendencies that were starting to take place here, failing at the 20-day moving average, heavier volume on the selling, lighter volume on the buying, the bounces not very strong, nothing compared to these bounces we were seeing before, and then breaking down below these prior lows, and you can see volume very strong. So even if you've got a great looking chart, you got a super support area that you're watching, you have to at least recognize the possibility that it is not going to hold. So you want to keep your stops in play. Look at how painful this stock would have been getting in at 42.5 if I just said, oh, I'm at gap support, I'm just going to hold. The next 4 weeks would have been pretty painful, dropping from 40, here all the way up 43 and change down to 36 and change in 3 or 4 weeks. So you want to be careful. Make sure you keep your stops in play. All right, ABM. Here you can see, this is the gap I'm looking at here. So here's the gap. You go all the way up and establish a high close, come back down. So that's kind of a resistance area. As you pull back, we actually printed a nice reversing candle. Look at that intraday move below gap support and then the reversal. That is telling you, again, I think that tells me that market makers are likely with a long position. because if you're breaking down intraday, who is going to buy a breakdown? I'm not. Most traders are not going to. The only reason for a reversal would be market makers buying on that dip below support. That's a lot of times how they create inventory to go long, is prices drop below support. They're not buying at support. They allow all the stops to start triggering, and that's where they accumulate on heavier volume, and then they reverse. They're buying into the close, and you can see over the next several days, we had a nice move up. Didn't quite get back up to resistance, but if you were trading that, probably could have had a 8-10% move in less than 2 weeks. Five Below, FIVE. All right, now this one actually on a couple of occasions, this one did, this was a gap support over here that I actually traded and ended up getting stopped out just barely. But I didn't like losing that support level right here. I think I lost a couple of dollars on that one. But look back to the prior gap up and this little tail coming down. Look at the volume. So the selling that took place intraday, remember, you get the gap up, market makers are on the sell side, but they could only take it down to about $95, and then the stock closed at $99. So that tells me that the buyers were out there around $95. Well, look at these next 2 months. If you're patient, instead of chasing at 105 or 110, you could get the stock right back down near that 95 level, keep a tight stop, and then have an opportunity to ride the stock on the next push to the upside. G3 Apparel Group. Look at the gap up here with heavy volume. Now look at this candle. This is a black candle off of an uptrend. A black candle is a reversing candle back to the downside. And what it's telling us is we're getting a huge gap up to $50 from the prior close around 43. But I would say market makers were able to get control of this one because we did finish well below the high. We went back up a couple days. Volume started drifting lower, couldn't get through. And we ended up a few weeks later coming back down and testing this gap support. 3 times intraday we went below gap support. All 3 times came back up above and held. Again, I think that is accumulation. The stock makes another move to the upside. And you can see with the exception of this one day in mid-August, that was a level that held for the next 4 months. And this was a trading range that could have been traded. Although that candle here would have been earnings related. I would not have been in on that. But again, it's just waiting and allowing prices to come back to key support levels. And now if you notice, after breaking down in October, look at where we're struggling to get through. That same earlier support level is now big resistance. And look at that false breakout there and what happened afterwards. Stock comes back down. So false breakdowns are bullish. False breakouts are bearish. Casey's General Store. Look at the big volume here. Huge volume. Gap up. Stock opened at 120 from a prior close around 116 and change. Went all the way up to 130 intraday. Still managed to close at 125. 130 was tough. Next couple of attempts up, couldn't get through. But notice where this last tail came down here on October 29th. If you wanted to wait and get in at 120, you could have done it right there. And literally, we'd have been right back to the top of the range. I would not have been looking for that breakout. I would have just been trading back up to that 130 area. I did not own this one, unfortunately. But again, if you follow it, you happen to catch it at the right time, it's a really nice short-term trade. Kroger. Now, Kroger, after gapping up back in June, look at the volume here on this gap up move higher. And again, look at where the tail came in. That's where the buyers were. And when you come across here over the course of the next 5-6 weeks, multiple tests, never broke below, at least not on a closing basis. And we ended up turning back up to the upside. So this tells you accumulation. Market makers couldn't stop it. Comes back down, consolidates on lesser volume. And then I think once the inventory is balanced out, then we start moving again to the upside. Another thing to do potentially with these stocks is, I'm talking a lot about gap support, price support, but also moving averages. If you get a stock that gaps up, sideways, consolidates, and then starts trending, remember that rising 20-day moving average can provide pretty good support. Now here at the very end, it didn't hold. Number one, I think we had another earnings report that came out, but also at the top here, look at this, higher price, lower PPO, negative divergence on that breakout. Volume, not exactly huge either. So signs of slowing momentum to the upside after that advance on Kroger. All right, Darden Restaurants. This is one that I think this may have been a setup a few weeks ago. Stock made a nice run. It's in that restaurant space, so it's in a really good space. But you can see right now it's just sideways consolidating. And I know, this gap was all the way back in June. But if we break below these moving averages, we've got support down here around 103, 103 and a half. But I wouldn't be shocked at some point if Darden were to get all the way back down into this area around 99 to 101. Very, very heavy volume, a lot of buying in this area. If we were to make our way, meander back into that zone, I could see a very nice, solid reward to risk trade developing. So even though this is a stock that had the gap up several months ago, if I was keeping a watch list of gaps, this is one that I would certainly hold on to and see if it comes down. You could wait and see if you get a false breakdown. That's one of my favorite trades, is to get that false breakdown, come back up above, and then look, maybe 8-10% move to the upside. Steelcase. All right, big gap. Look at this, all the way back in September. No chance it's going to come all the way back down to 16 from 19, right? Wrong. About 4 weeks, came back down to the 16 level, hit into the support area. And the lines, I think the first line here is the gap support. And the second line here I just drew because that's where buyers off of this downtrend came in, and we saw that reaction high. So this area is pretty good support. Could get all the way back down to the top of this gap support, down at 15 and a half. But I wouldn't be surprised to see a reversal here. This is one I'm kind of keeping my eye on. If we get a intraday break below and we start to rally off of that, that could be a pretty good sign, similar to what we saw here, where we had the breakdown below this gap support and then rallied back. And you can see over the course, once it came back up above 16, that's almost a 10% move in about 5 trading days. Helen of Troy. Well, you've got the gap up here. This is a little bit of a different picture. That's why I wanted to show this. Here we gap up, we move up, we come back down, and we break below the top of gap support. Now, if I had seen that, I would have been thinking we're probably going to go back and fill this gap. But notice we got a hammer, and we printed this tail to the downside to mark short-term support. Then we went all the way back up to 120, couldn't get through, so clearly we have resistance there. And look at the next push back to the downside. We went back to 110 again. Now, at this point, you can get in fairly tight stop, and you know where your resistance is, up near 120. And here in about 7 trading days, probably 8 or 9% move. And eventually it did get to that 120 level and above. But again, the trading, not just with earnings, the gap higher, but also the next few days sometimes can establish a nice trading range for you to watch as well. Danaher, DHR, gap up from 98 and change up to 106. Don't chase it. Black candle, came all the way back down. Got within probably 50 cents of gap support after gapping up 750 higher. And look what happened afterwards. Nice move back to the upside. Don't know how long I would have held if I had owned it, but I know I wouldn't have had a whole lot of downside. And that, again, is pretty critical with trading, any kind of trading. All right, MGIC Investment Corp, MTG, gap up, very heavy volume. The tail produces that support zone right in here, $11.70 to $12. Now, it eventually didn't hold. And again, you got to have your stops in play. First test did, though. This is a stock that went just below $12, came back up, and it ended up going up 10% in 3 trading days. That is not a trade to sneeze at. I know you might look at this and say, well, it eventually went lower. I'm just looking to trade, to get a quick pop. I'm not looking to buy and hold and marry a stock. So that's just my strategy. I know many of you do like to hold longer term, and that's fine. Everybody has their own style, strategy, reasons for doing that. But for me, I'm short-term trader. So this is the type of setup that I'm looking for and I'm waiting for. That's why I keep this chart list. Hundreds of stocks in it. Intuitive Surgical. Well, I think if you go back, I think it's pretty clear to see price support. And that was the main thing here. 2 lines. One is the bottom of gap support right here. We went through that, but price support held. And the thing is, we have now hit that three different times since breaking out in June on pretty good volume here. And so I would say that this 470 level on a closing basis is very significant. maybe go down to 460 on an intraday basis. But this is a really important zone for a stock that's been a really clear outperformer for a long, long time. So ISRG established a high at 580. I think has established a support level now at 470, and that's the trading range that I would be looking at. PayPal. Look at PayPal just recently gapping up. The blue arrow marks the gap up with earnings. We've kind of traded up. We just came down and put in this tail down to this price support level, reversed, held gap support, and now we're starting to move up. This was actually the setup for this week that I featured in my blog earlier. Big move here on PayPal, back to the upside. 75 to 77 range, I think, is pretty solid support here. Atlassian Corp team. This was one of the best performing software stocks until October, when many of these high growth technology companies started getting hit so hard. $97, $98 came all the way back down, but notice where it found support. Here was the earnings report where it had gapped up. The gap support is about $67. We went from 97 down to 67 and literally turned on a dime, up 10% about 3 or 4 trading days. Came back down. You can see gapped below. Again, I would be looking at that saying there's no way I'd be buying on a gap below support. And it starts to move down to 65, and then it reverses. And literally, once it comes back up above that level, 66, 67, 10% move in 3 days, back up near resistance. So it's really critical not just to watch gap support, but also price support and these candlesticks where you've got these intraday moves below. You come back up. The beauty, again, is even if you're wrong, if let's say you get in here at 67, you've got to stop at 65. If you're wrong and it turns back around, you lose 3%. If you're right, many times you'll get that 9, 10, 11% move back up to resistance. And it's that accumulation of 11% or 10% or 9% winners versus 2 or 3% losers that eventually builds your capital. All right, just a couple more here. Let's take a look at IPG. This is actually one I own. So here we gapped up. Look at the volume back in October. The clear support area, in my opinion, is 22.60 to 23. Stock goes all the way up to 25. Look, it fails at resistance. Pretty key resistance. So I know my resistance now is at 25. I know my support is in here at 22.60 to 23. And look at where we closed. Look at the volume. This was back on Friday of last week. Holiday shortened session, light volume, just kind of moves right back into this support area. And now the last 2 days, nice move to the upside. Stock's up about 5% in 2 days and continuing to move higher. Procter & Gamble, this is one just to keep on the list. This is a possible trade off the 20-day. I'm not a huge fan of trading the defensive stocks simply because they don't move as much. But if you want to be a little safer, they do provide more safety. I would watch the 20-day, though, because I've shown you on many charts where once you fall below that 20-day, you tend to meander your way all the way back down towards some key gap and price support levels. And the key gap support level, you might think, well, we'll never go from 92 down to 84. But again, I think if you look at enough charts, you'll see that it happens all the time. So this is a key level if we were to get back down there. All right, OFG, Oriental Financial Group. Here you can see the gap up back in July, increasing volume on this push to the upside. The tail comes down to establish that low. I could have even drawn this support level back at the prior low, which would have been the bottom of gap support around 1450. But notice after 2 months of declining, what happened to OFG? It bottoms there, starts to make a move. This may have been earnings related right here on this candle. So if it was, I probably would not have been holding, but it reestablished a nice move to the upside. And if it comes back down, I think it's pretty clear you've got nice support around that 15 level. All right, last one I have is Biogen, BIIB. Here you can see the huge gap up, 2 big gap ups back in July. And notice the bottom of gap support. This is one that if you're at 300, the stock goes up to 350 and then to 390. You're probably thinking, all right, this is not going back down to 300. Well, 3 months later, it went back down to 300. Actually went a little bit below where, again, I would not have been a buyer, and yet it comes back up above, and look at the resulting move to the upside. So when you get these false breakdowns, I think you got to be ready with a fairly tight stop. You got to be ready for a recovery. Now, I will say also that the market has a lot to do with what's going on. And with a volatility index where it's been recently, I do think that it's difficult to, take any chances. I would probably take a little bit more of a chance in a bullish market with the VIX down around 10 or 11 than I will in a market like this. There's just too much volatility. The impulsive selling could come back at any time. I don't want to be, trying to find out whether or not, I'm holding in an impulsive selling or right before an impulsive selling period. So make sure you keep your stops in play. So my items of importance when I'm trading, these are some of the things I look for. I look at the candlestick on the gap. Is it a black candle? Is it a hollow candle? Does it continue moving higher after earnings? Because I think that then establishes probably the top of gap support being very important. The volume on the gap. Now, I went over a lot of earnings related gaps, and they are generally going to have very heavy volume. But I think that's really important. If the volume's not there and you just have a gap up because something else going on in the market, I would look probably 8 times out of 10 for a gap fill. Price support and resistance, talked about that quite a bit. Moving averages, if you want to short-term trade these stocks that haven't pulled all the way back, but they're coming back and testing that rising moving average, like the 20-day, you could always take a chance. But again, you want to keep that stop tight. And then I didn't really talk too much about it, but I do think it matters to take a look at relative strength of stocks or industry groups and just see how they're performing relative to their peers and how their peers are performing relative to, say, the S&P 500. Because if I'm going to feel better about a stock that's in a strong group than I am about a stock in a group that's been free falling. All right, so hopefully you enjoyed that workshop. I think maybe what we will do is pull up the poll in just a second and maybe take a look and see what everyone uses. I don't know if you had a chance to take a look at this, Erin. I know you don't do a whole lot of short-term trading, but what's important to you? I know you use the PMO.
Yes. So when I was looking at it, I thought, well, before I started Market Watchers, I probably have been in the I never short-term trade camp. but doing Market Watchers now for, gosh, it's been what, a year and a half, almost 2 years. Ooh, can't believe it. I do short-term trade now because my eyes are on the ball a lot more than they used to be. But I would have to say, in order of, because I pretty much use all of those, because all of them are on my daily chart. So that's kind of how I looked at it. But as far as importance level, yeah, the momentum oscillators would be my number one, and my number two would be the moving averages. And then from there, I look at, the support and resistance. That would probably be number three. And then trend lines, and then volume, sort of my last. It's a confirmation tool.
Okay, but you use all 5 of them?
I do. Because all 5 of them are on my daily chart. So it's hard for me to say that I don't use one of those. They're all pretty much on there. So when I do like I said, in order of importance, I would go momentum oscillators like everybody has here. I would say that my second one, though, would be moving averages, because I like to look at whether we're in an uptrend or a downtrend, of course. And then I would go with the support resistance. Mm-hmm. And then trend lines and patterns, as well as volume, I consider confirmation.
Yeah, I wanted to see how this stacked up. I'm a little surprised that momentum oscillators was number one. Mm-hmm. I would have suspected price and gap support would have been number one. That most traders would look at price support and resistance as their number one go-to. Mm-hmm. But hey, everybody's different. Everybody trades differently. If I was ranking these, for me, price and gap support would be number one. Volume would be number two. Momentum oscillators would be 3. Moving averages 4, and trend lines patterns would be 5.
Yep. And it's just, honestly, I think all of them are important. It's just a matter of which way you do prioritize, and that's the way you trade. And that's okay if they're different. That's why I think it works well that we have kind of a different style. Mm-hmm. So people don't get bored.
The primary difference, I think we use a lot of the same stuff. I think our primary difference is just prioritization of what's the most important.
Right.
Momentum oscillator, and I use price support. And the two sometimes will line up. They don't always line up. A lot of times they're button heads. Mm-hmm. Because if you pull back in price, to a support level, your momentum oscillator is going to weaken.
Exactly.
And then you're going to start looking at this, okay, the momentum oscillator is going down and it's getting a crossover, so I don't like it. And I'm going to be saying, hey, it's hit price support. I love it.
Right.
So that's, for anybody listening and, maybe trying to compare the way Erin looks at the market and the way I look at the market, I think that in a nutshell is really.
Yeah, that's pretty much it, because you are so short term as well. I mean, you use the candlesticks, which of course are, very, very, very short term patterns.
Mm-hmm.
They're chart patterns, and I don't follow those because they are super short term,
Mm-hmm.
and I just don't. It doesn't affect my decision making. So
and I think that is key for me because I am so short term. The momentum oscillators, they lag price action.
Yeah, absolutely.
And so a price turns up, and a lot of times I'm in a stock, hopefully if it works out, I'm in a stock, and if it goes up 10% in 3 or 4 or 5 days, I'm out right at about the time the momentum oscillator is coming up and signaling that, hey, things are starting to improve again. So
exactly.
From perspective, it's too late for me to wait on those oscillators to give me a signal.
Yeah. And again, totally makes sense with our styles.
Yep. All right. Well, it's time.
I'm right or wrong.
10 and 10.
Yes, let's do this. All right. I'll grab the screen here. We'll take a peek at what we have. About 24 requests today. Here is our RRG. What we like to look for when we pick stocks are the northeast direction. That's what you want to see. What I thought would be interesting to talk about a little bit here is just which ones were green, which ones were improving, lagging, weakening, and notice what sectors. So in the leading sectors, of course, all of these are mostly defensive areas. And then we can see the improvements starting in the consumer discretionary comm services. You can see a few here in the weakening. But now, and then we've got the red. What's in the red? Technology is a big one. So interesting stuff. Let's go ahead, though. I'll give it back to you. Altria Group is our first one, MO. All
right. Well, you got one good thing, in my opinion, that is you hit price support. That's all I'm like on this chart. I mean, look at the volume coming in on the selling from 66 back down to 53. Ooh. I mean, we had a really nice uptrend in play there, and it broke. I mean, you could connect a trend line along probably the 50-day moving average. We gapped below, looked like we were going to try to recover, and then we went right back down. And since then, it has been a big move down. And again, that volume is a problem for me. So we hit support. So if you wanted to trade it, I would be okay with it. Not a big fan. I mean, I don't think this is a healthy chart, but the fact that you are at support keeps your stop tight. So I could get in with and just say close below 53, I'm getting out. But I would only look, because this is so weak, I would probably only look for maybe a $4 bounce or so. I mean, if I got anywhere close to that 20-day moving average, I'd be taking my money and running. Okay,
let's see. Most popular in the chat room right now. Well, it's just high, so I'll be doing both of them. But let's start with CGEN.
All right, CGEN's in the biotech space, and it continues to move lower, which is a problem. Biotechs continue to move lower, which is a problem, although I think 1850 is a major support level in biotech. So maybe getting into some biotechs at this level wouldn't be a horrible thing because you can keep stops tight. I just don't think it would be CGEN for me. As you can see, CGEN relative to the biotech index, very, very poor performer. So I'm just not seeing anything here yet that would suggest that we are, ready to start trending higher. If you look at the downtrend that it's been in recently, I mean, you couldn't even get to the 20-day moving average on these bounces before we turn lower. And you can see volume trends are still negative. I'm just not seeing anything here. I'd wait.
Okay. Let's see. The other most popular in the chat room was Micron, MU, of course.
Yeah, I'm starting to see some pretty good signs out of some of these semis. I like the fact that on Micron's last move down here, this hollow red candle putting in a double bottom, but we need to get back up and clear about $41 before I'd really start to feel better about it. So let's go ahead and annotate here. I've just noticed the trading pattern on some of these semis that have been hit so hard. They're starting to look a little bit better. And I'm thinking about Micron. I'm thinking about Applied Materials. There's so much bad news that's built in. This is a stock that was at $65 in May and just went down below 35. That's pricing in some pretty bad stuff, I would say. So I'm not sure that we haven't bottomed at this point, but I don't think we get that confirmation until we get a breakout above 41. You certainly could take a chance, but if you do get a breakdown, especially if volume picks up, then I would be careful. But I would say maybe 33.5 to 34. Watch that level to the downside. And the big breakout would be a move over 41.
Okay. Let's see, another popular one, Gilead, GILD.
All right, another one in the biotechs. So let's see if this one looks any better. Not really. Here's Gilead relative to the biotech space. So let me annotate this one. I mean, we are down near support level, but again, you don't have one of the better stocks. I mean, if you're playing this maybe as a breakdown, false breakdown and recovery, you could use today's low as a stop, but I'm not really seeing a huge support here. The bigger support obviously is going to be that massive sell-off that took place back in early May, which would be down closer to 64. If I was going to trade Gilead, I would like it a lot better down around 64. I mean, the volume on the last move down, you can see, was still pretty heavy. I think it's got further to go to the downside. 64. Let's see what happens if it gets down there and then maybe revisit.
All right. And one of your favorite industry groups of gold mining, how about Kirkland Lake Gold? And that's KL.
All right. Yeah, I'm not a big fan of these stocks, mostly because I just don't like, I like the dollar. And if the dollar goes higher, that is a headwind for not just gold, but for many of the material stocks. So I'm pretty nervous about gold in general. Now, this one, I think we may have looked at this one before. I think on a relative basis, this has been a pretty good stock. I mean, we're talking about a stock that had been uptrending throughout all of 2018, or at least until August. And then we pulled back, and that's going to be an important low going forward, because right now it just looks to me like consolidation. So here's the group, and you can see it's been going down, but this has been one of the better stocks within the group. So the real question comes down to, do you want to trade an area of the market that is not healthy? In my opinion, it's not healthy. And my answer is no. I don't necessarily, unless I'm getting a great deal right at a major price support, maybe with a false breakdown, something like that, then I might jump in. But I don't like the group. And right now, it's in the middle of this range. I don't see a trade unless it were to fall back, maybe move down to around 17.25 intraday, close back up like at 17.75, and then maybe it becomes a short-term trade for me. But otherwise, given the backdrop in gold right now, I would pass on it.
Okay. Let's see. The next one, gosh, it reminded me of Mamma Mia. It's Altaba Incorporated, a comm services internet. It's AABA. Reminds me of ABBA.
Yeah, the singer.
Yes, the group. Yes, Mamma Mia.
Don't. Let's not start singing, please. We won't have.
Trust me, I would never do that to our audience.
All right. I'm looking at this downtrend, and we're trying to break through, but I want more volume. So I'm not convinced yet that we have broken this downtrend, but it is starting to look a little bit more interesting. Notice that for the most part, that 20-day moving average has been declining, and it seems to be bottoming and trying to turn back up. But I want to see a little bit more accumulation. And once again, look at the group it's in, the internet stocks. I think you got to be really careful here. I'm going to pass on it for now, but if you like the stock, maybe keep it on a watch list. And if you get some volume coming in, or maybe go back and test that 20-day moving average, that at least would cut some of the risk out of the trade. I'd be more interested there. But I do like the fact that it's trying to clear the trend line resistance. I just want to see a little bit more volume and a little more confirmation on this.
Okay. A couple of questions about what you would thought of the retailers. So I picked up XRT for you to look at.
All right, actually, we don't need a relative chart on that one. So let's just take a look at XRT. Oh, all right, let's go to a weekly chart. And let's go out a couple years here, because obviously retailers made a huge move to the upside, and they've been pulling back. You got a higher high, higher low, higher high, higher low. So the overall pattern is still okay, but probably, tell that somebody who bought these stocks in August and September, and they're probably not going to be buying it because it has been very weak in this space. Retailers have really hit the consumer discretionary space pretty good. But I do still have hope, especially if this is just a correction, as long as this pullback here back in February and March holds, very similar to the overall market. So as long as that holds, I'm okay. And I think we could get some pretty good opportunities in this space. But if that level breaks and the overall level on the S&P 500 breaks and we're trading, down 25.50 or below, I'm not going to be feeling very good about retail or much of anything else at that point.
Mm-hmm. All right, let's look at a consumer staple food retailer, Sprouts Farmers Market, SFM.
All right, SFM. Well, I think your support is pretty easily defined right here, looking across. And that is right there. We haven't had a close below about 26.20. We've had intraday moves down to about 26, 3 of them here at the beginning of November. We're sitting at 26.68, so you got about 3% to the downside right now. To the upside, the recent highs is what I would look for, 28.50. I mean, you could set up a decent trade here, but a little bit more of a pullback, more toward the low of today, 26.34 is much closer. And if we got down to 26.20 or so, or even 26, I think that would even be a better reward to risk entry.
All right, let's see. PayPal.
Okay, I pulled that one up earlier, but we can take another look at it. I like it. Again, I had it on as my setup, one of my setups. It was the one I featured in my blog this week. I think the 20-day moving average is going to be the first key on the stock. But if we're just looking strictly at price support and resistance, I think price support, you've got that coming in at 75 there. This was your gap support from the earnings gap. You can see that heavy volume. So that reversal in this area, I think, was pretty important. But we've got to get back through the 20-day moving average. If we can do that, and we see the overall market strengthen above the areas I talked about earlier in the show, then I think PayPal's got a reasonable chance to make another run back for $89.
All right. Let's go ahead and finish it off with our only industrial request, Delta Airlines, DAL.
All right, DAL. Well, the airlines have been strong, and I tell you what, UAL I think looks even better. But DAL has definitely been strengthening. Nice volume coming up off these lows. It seems to be, headed straight for this 59.60 area of price resistance that was established back in September. At that time, you can see on the higher highs right here, you did have a negative divergence. We failed to hold the breakout level. That's usually a bad 1-2 punch right there. And we continue to sell off for a while. But I think one thing that's certainly helping the airlines right now is the tumbling crude oil prices. That started back at the beginning of October, and you can see that just about coincided with the move here on Delta off the lows back toward the highs. So if you believe that energy is just taken too much of a hit to the downside and may bounce, then I would be expecting Delta to struggle at that overhead resistance between 59 and 60.
Okay, that does complete the 10 and 10. So you will find those charts that we are showing you right now. You'll find those in the Market Watchers live chart list. So you'll want to go over there and get those slides, or I'm sorry, charts. Just go to the blogs tab and click on the Market Watchers live blog. All right, time for our final market update. So let's get to it. All right, I thought I would use the new chart view. So we'll go ahead and take a look at what's going on in the markets. It's very nice because we can look at all of the different percent changes, as well as click on the ones if we want to see the 10-minute bar charts that I have here for you. So let's go ahead to the S&P. As you can see, we are trying very hard to close the gap that was formed back here on the 20th. It looks like on the open. We haven't gotten there, tried to, failed, and now are back in negative territory. I don't like seeing that personally, a failed rally. We'll have to see how much we get past that. TSX, 10-minute bar chart, very interesting looking, I'd have to say. We've actually tested support from the 23rd, the trading that happened there. We'll have to see if it can hold that as an intraday low and move its way back up. All right, let's go ahead and look at some of these other major indexes. The NASDAQ 100, as you can see, it's been trending higher which is always a good thing. But if I annotated this chart, I can almost guarantee we would be looking at a rising wedge, which is bearish. So I would expect to see a breakdown below the rising bottoms trend line that we're forming right here from the 20th of November. Mid caps and small caps, you can see similar. With the mid caps, we did open lower and gapped lower on the open and are continuing lower. S&P 600, similar situation. Looks like it may have found some support here at the 937.50 area for the S&P 600. Sector spiders, as you can see, we have our best performers is going to be down here, with the XLU being what we're looking at as the best. Notice the really nice rising trend that it has been in since the 23rd of November, closed up gaps. All of this looks pretty good to me. And you can see as far as the suffering is going to materials right now. Big move to the downside, continuing lower. And that's all I have for our final market update. Go ahead and let us know in the survey comments if you prefer this to the candle glance. I'd appreciate it. All right, Tom, what you got for us?
All right, I'm just going to do again just a quick look at that S&P 500, and I'm going to do it on the hourly chart. I just did a quick annotation here, but this is that 2680 area I was talking about. I actually could also put in a line. There's the top of that gap support that I was talking about here around 2690. So you can see that the S&P today did get up to that 50-hour moving average. You can look at the PPO, the hourly PPO, right to the center line, very similar to this last move up. And you can see it was a struggle to stay above that 20-hour, and it seems like we're doing the same thing. So I kind of agree with you. I think that this is, unless we see some strength later in the day, I mean, maybe we'll explode to the upside. But barring that, I'm really not overly excited by what the market's doing here. I know we gapped down earlier and we went positive. I think that's good. But we've talked a lot about afternoons. And when the market is declining, what you don't want to see are these big afternoon declines like we've seen before during some of these rallies, the last couple hours. Sometimes it's just the last hour. If this is truly an uptrend, we should see some buying later this afternoon. And currently, it's not looking very good, but we do still have almost 3 hours left in the day. So we'll see what the afternoon holds. But currently, kind of dicey, I would say, at a minimum.
All right. Very good. Let's go ahead and move into technical scans. I'm going to show you how to use the predefined scans. And Tom, tons of questions on how you scan to find those gaps. I'm not sure if you use the predefined scan, but I'm going to show people how to do that.
Yeah, my gaps mostly come from earnings reports where I set up the charts. So they're not really looking for anything in particular in terms of percentages. They just happen to be stocks that have reported earnings, probably good, solid earnings. And I like the overall chart. And then I just store them in a list and I just wait for the, different buy points to trigger.
All right. Okay, so let's go ahead and I'll show you. I'm gonna center it on the Elder Impulse system, but I'll show you also how you can do it with the gaps, because we do have a gap predefined scan. So starting from the member homepage, and I do believe you need to be an extra member or at least a member to get a hold of these predefined scans. And I know in order to customize them, you definitely have to be an extra member or above. And we are running a holiday special right now. Buy 12 months, renew for 12, and you get 2 months for free. So something to consider on the side. So let's go ahead and look at our predefined scans. And if you take it down here, the bullish technical indicators, you have gap ups, you have the breakaway gaps and runaway gaps. And I don't know exactly how those are determined. Best way to do that is to go into the scan itself. And you can look and see how it's determined what a gap up is considered. So it looks like a little over a 1% move, a greater than the low from previous. So as you can see, that's what we have as far as finding gap ups. And we do have, like I said, the breakaway and runaway gaps, if you want to look at those as well. But I was going to, like I said, I'm going to concentrate on elder impulse because we do have a predefined scan on that I wanted to use. So if you want to learn more about the elder impulse system, go to Chart School or to the search box and type in elder impulse, and you'll get all of the lovely information. But I'm just going to give you a real quick one. What we look for on elder impulse is you want to get these buy signals, which are the green bars that come up and you get the green bar above the EMA. So let's look down here. So this is depending on your time frame. He explains that as well. So if we're looking at a daily chart, which of course is what we're going to be looking at, you want to see the switch to a green bar. That tells you that's a buy signal. If that green bar happens below the 65-day EMA, then it doesn't count. So what we want to do is look at where we can find those stocks that have a green bar that just appeared above their EMA. So let's go ahead and go back to our predefined scans page. And again, you can get to this from the members dashboard. Just go to the scanning tile. So here are the bullish technical indicators and the bearish ones. And under candlestick patterns, I believe it's under the candlestick. Yes, elder bar patterns. And so we're going to look at the elder bar patterns that have turned green. And there are 545. So that's kind of a lot, obviously, to start looking at. There's also exchanges in here I don't want. There are prices that I don't want. So what I would want to do with 611 is I want to pare it down to something that makes sense for me. You know, I like the idea of the elder bar. So I got this group, but I want to edit the scan so that I can take out the things that I don't want. So I'm going to click here to edit the scan. And here is obviously like how they calculate it. So I'm just going to copy this information. And then I'm going to go to my general PMO scan, which is the one I love. And I'm going to narrow down my universe by using that information from the elder impulse. So I'm just pasting that in there because that gives me one that's a stock and it gives me all the elder stuff that I want. But I don't want any penny stocks, and I want to see if there are any that have the PMO that is rising for the last 3 days and is less than its signal line. And I want the EMAs to have a certain configuration. And then I'm hoping I can find some with a scooter also above 75. So this is how I edited it. Now let's go and see if we run this scan. Nothing. So if I wanted to use elder, I'm not going to get anything using that scan directly. So what I have to do is manipulate it even further. So we come back here. Usually I find if I take out the scooter requirement and I take out one of the EMAs or the last one of the PMO rising. So I'm going to just do the last PMO rising. I'm going to take that out and I'm going to take out the scooter. Now let's see what we get. And we run the scan and it's going to be this tab. We're still at 0. So I have to continue to manipulate it. I'm going to change the requirement for the EMAs set up here. Because I really do want just the elder, but I wanted to get out the, I want the US stocks. I don't want the London. And so this is a way for me to get that out of the predefined scan. Perfect. Now we have 46 results. And the best way we can fix this, now I noticed also the London and those are still on here. So we have to go back and fix that on our scan. We want the country to be US. So we go to ticker properties, country, add that. And at the bottom, it adds, and country is US. So I'm just going to take that and put it up here as part of my universe. And now I'll run that scan. There we go. That took out a lot. Now we're down to just 16. So in order to manipulate this, you do need to put it in a chart list because you can go through and click on what you want here, and you can sort them. by the exchange or the sector, you can do that, but there's no way to use candle glance, which is what I like to use. There's no way to just arrow through it like you can in Chartbook, in the Chartbook way to look at it. So I need to get it into a list. I have a transient list that I call scan dump, and it is transient. Anything that goes in here, I know that it's going to get written over. So that's fine. It's just transient. If I see something on here I want to add to a watch list, then I'll save it over there. But this is just the scan dump. This is just where I can get in and get out. So I'm going to look at this in the candle glance style that I like, which has the PMO and my EMAs on it. And now I can go through here, and using the Elder Impulse system, I can get everything narrowed down. I'm not going to show Elder Impulse on my charts, but I'm using it to come up with the group that I might want to look at as far as, inspecting for investments and that sort of thing. So that's the easiest way to do it. So let's go back to what we did. I'm going to just do it a little bit slower, a little faster, a little slower. All right, so we're going to go here to our member dashboard. We go down to the predefined scans. I found the scan that I wanted, which was down here under candlestick patterns, elder bars. I wanted this one, so I clicked on it. Okay, I clicked on it, and there it goes. Too many, right? So I need to edit it. So I clicked to edit. I copied it, and I pasted it into my scanning workbench, one of the ones that I have, the general PMO scan. I pasted it in there, and I added that the country had to be US. And then I also commented out a few of the requirements just so that I could get a bigger pool of stocks to look at. So I fixed it, the predefined scan, to the way I wanted it. I ran it. I got my results. And then I saved it to my scan dump. Okay. And then I looked at it in my candle glance. And you can also set up your own candle glance. Just set up the chart the way you want it on your candle glance and save the chart style as candle glance. And then you'll get exactly what you want to see in the way you want to see it. So that is the way that I set it up. I'm going to show you, since I have just a little bit more time, how to turn this scan into an alert, so that you don't have to wake up in the morning or run this scan in the afternoon on your own manually. You can set up an alert to run this scan, and if there are any results to the scan, it will send you a text if you want, or it'll send you an email if you want. So I need to set up that alert. So this is the scan, remember, that we created with the elder in it. And I'm just going to take the whole thing and I'm going to copy it. And we're going to go back to our member dashboard. And we're going to go down to the alerts. And I want a new one. So I just click new alert. And I'm going to use advanced because that's where I can put in my scan language. So I'm going to put that in there. And then I can adjust if I want to run it all day, if I want to run it just at the close. And if there's more than a 0, alert me. You can pick email, SMS, whatever, or on the workbench while you're on stock charts, however you want to do it. And you can pause it, continue it for as long as you'd like. And then you just save it. So now that scan has become an alert for you. And you can do this, of course, with any of the scans that you like, so that you don't have to necessarily run it all the time every day. So let us go back to our scan dump. And I'm going to close it out because I know, like I said, Tom, there were a few questions, and I just want to make sure that you get to some of them from the chat room, because sometimes our viewers are not so happy if we miss out on some of these questions. So I wanted to do that. But here's the summary slide of what I just went over. And yes, and we didn't actually look at any stocks in particular, but that's how you can go ahead and take a predefined scan, use it to combine it. I combined it with my PMO scan, and then you can create a technical alert using those. So hopefully that was helpful. I'll probably run this this whole thing again in 2 weeks, so you can get, but we'll use an example on the gaps maybe instead of Elder Impulse. But I promised everybody Elder Impulse, so I figured I should do that. All right, Tom, I got some questions for you.
All right, what you got?
All right. So first of all, I think like what you were saying, that is there a scan? They want to know if you use a scan. So you actually are going in and using, it's more of just your earnings chart list, and when they report earnings, you know there's likely to be a gap, and then you just go back that way manually?
Yeah, I look at all earnings reports when they come out. I mean, I do a lot of homework putting together a chart list of companies that have beaten top and bottom lines, and I look at their charts, and if I like them and they're liquid, then I add them to a watch list. And so at any given point in time, I usually have anywhere from, I don't know, probably 100 to 300 charts in that list. And then a lot of times what I do is I wait. I think there was a question in the room asking about, how do you track all of the stocks on your list that are pulling back? If you have a certain price that you want to buy each individual stock, that's a pretty tough task.
Yeah.
Well, what I end up doing is I take a look at my list, my chart list, and I sort it. And I sort it by performance that day. And I actually start with the stocks that are getting hit the hardest on my chart list. And then I pull those charts up to look to see. And so I'm going to give you an example. One of the stocks getting hit really hard today is ASNA, which is a Cena retail group. Now, this one doesn't really have any gaps on here, so that the whole gap thing, wouldn't necessarily apply. But what I'd be looking for is some kind of reversal. Like here, I actually had kind of been watching this stock because it had a support level around 3.25. You can see here on the very heavy volume back in early June, it got down to about 315. So this area was kind of intriguing to me. But today you can see it breaking down. Now the volume is not very big, but this might be one where if it reversed back hard today and finished at, say, 3.25, I might be interested in, because it would be leaving when I look at a chart like this, and this is what I was talking about earlier, when I look at a chart like this, there's no way I'd be a buyer. I don't see any reason to buy on a potential breakdown. But a reversal here might be a different story. Now, I will say that we had a similar case back in October where it moved down. Didn't really have a major support level, but you can see that long tail that was left. But on that downtrend, the volume was not nearly as strong as it's been on this one. So I'm a little nervous about this one. Maybe another one that, to give you an example, would be FND, which off of a downtrend had gapped up. I think this could be a character change on this chart. And you can see on light volume it getting hit. But right around $30 is a pretty good gap support area. You got the 50-day moving average down there as well. So what I do is I just take a few stocks and I look at toward the end of the day and just kind of see where they're trading and whether or not, they look like they're possibly good trading candidates.
Do you trade off of hourly, daily, weekly, typically? Which one?
Oh, yeah, I'll definitely do an hourly chart. Many times if I'm hitting a support level on the daily and then I look at it on an hourly and have a positive divergence, to me, that's confirmation.
Oh, excellent. And so as far as a gap up, does it have to be a certain percentage up, 2% or more? Does it matter to you?
I think it demonstrates a lot of accumulation if it gaps up more and then continues going higher, because as I explained earlier, when everybody wants to buy, market makers, their role is to provide liquidity on both sides. So you have to be looking at a possible reversal after a gap up. So I want to see that continuation. But the percentage doesn't matter necessarily, but I probably would prefer a little bit more than less. Okay. Thanks for the questions, and love to hear from everybody what you thought of the presentation, and definitely want to thank everybody for being with us today. But do complete that survey if you get a chance. Love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 Eastern Standard Time. Have a great afternoon, everybody. See you back here tomorrow. Happy trading.